The Committee on Digital Assets, Financial Technology, and Inclusion will come to order. Without objection, the Chair is authorized to declare a recess of the committee at any time. This hearing is entitled Bureaucratic Overreach or Consumer Protection, examining the CFPB's latest action to restrict competition in the payments. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the Chair for inclusion in the record. I want to recognize myself for 5 minutes to give an opening statement. Today's hearing, Bureaucratic Overreach or Consumer Protection, examining the CFPB's latest action to restrict competition in payments, in my view, is critical because it's going to talk about this large participants in the general use of digital consumer payment applications market. This is the 6th LPR that the CFPB has initiated. And putting aside the egregiously short comment period, which frustrates both members of this committee, the deeply flawed cost-benefit analysis, which have become hallmarks of this administration, I find the substance of the CFPB's proposal deeply concerning. The proposal asserts that companies that let you send monies to friend, peer-to-peer, or companies that keep your credit card information on your phone somehow are in the exact same market. Why? Well, just because the CFPB says so. This breadth of the market the CFPB is trying to define has perplexed many on this committee, from potentially covered entities to, as I say, on both sides of the aisle here. Many companies are utterly confused, wondering not only how the rule will be implemented, but whether they're even covered by it. I would argue that this confusion is by no means an accident. The CFPB is trying to cast as wide a net as possible and become a technology regulator. And in many more ways than one, this proposal marks a sharp departure from the CFPB's previous large participation rules. Director Chopra has decided on a whim, and in my view, without justification, that technology companies pose a threat to consumers, and this rule should be viewed as a thinly veiled workaround to get CFPB supervision teams into these tech companies. And that's because once an entity is designated as a large participant, the CFPB can not only supervise the activities, which is what I think the intent of Dodd-Frank was, that originally qualify, but they can actually supervise the entity's business itself. The proposal attempts to establish limits by only capturing those companies with 5 million transactions within a year. So we'd love to hear from the panel on, is that a good number or a bad number? But don't be fooled, this modest threshold is so low the agency will effectively have carte blanche to knock down the door of companies large and small with their fleet of examiners. There's no doubt that this proposal will decrease incentives to innovate in the payment space and leave consumers encumbered with fewer firms from which to choose a payment method. That decreases competition. This LPR doesn't benefit consumers or provide market clarity. In fact, the only people this proposal potentially will benefit, besides witnesses like you, are compliance lawyers. To further expand their authority, the CFPB has decided to capture digital assets under this proposal as well. The CFPB asserts the definition of funds includes digital assets. This is a novel position, and the CFPB justifies the interpretation only in a very small, unassuming footnote. Concerns around this proposal are not strictly partisan. Comment letters were submitted by both sides of the aisle to express concern about the proposal's scope and implications. The CFPB needs to go back to the drawing board, work to protect consumers, and not hinder innovation or expand the CFPB's insatiable reach for more power and scope. We thank our panel of witnesses for being here today. We greatly appreciate your testimony and willingness to work with us. And I now yield to the ranking member, Mr. Lynch of Massachusetts, 5 minutes for his opening comments.
Thank you, Mr. Chairman. Good morning. I'd also like to thank all of our witnesses today for your willingness to help the committee with its work. It is the fundamental mission of the Consumer Financial Protection Bureau to safeguard American consumers against unfair, deceptive, and abusive financial practices and discrimination. The CFPB also ensures that our markets are for consumer products and service operate fairly and efficiently in the interests of consumer access and responsible innovation. In furtherance of its critical mandate, the CFPB recently proposed a rule, as the chairman noted, that will allow the agency to exercise supervisory authority over larger non-bank technology companies that offer digital wallets and payment services. This includes peer-to-peer payment apps and electronic funds transfer apps. Importantly, this rule will place Apple, Google, Meta, and other big tech companies that have moved into the financial services space on par with financial institutions that are already there and are already subject to CFPB supervision. However, unlike large banks and credit unions, these companies do not currently undergo CFPB supervisory exams, periodic monitoring, or compliance checks. They may not even be required to insure company funds or deposits. CFPB action in this area is timely, considering the escalation of shadow banking, that is the migration of core banking activities to non-bank entities, which currently fall outside the scope of traditional bank regulation. The rule is also necessary, given the growing expansion of big tech companies into the financial services sector and their deployment of opaque artificial intelligence technologies. As reported by the CFPB, consumer usage of digital wallet tap-to-pay options in the U.S. has already reached $300 billion, and is estimated to grow by over 150% by 2028. Moreover, an estimated 2/3 of all Americans, including a majority of low to moderate income users, are now relying on peer-to-peer digital payments, such as PayPal and Venmo. Many of these providers have already launched cryptocurrency payment and transfer options. So it's not surprising that the consumer advocates strongly support the rule. According to the Consumer Federation of America, quote, "We would be concerned whenever the line between commerce and banking is permitted to blur. By closing this loophole, the CFPB is moving forward to hold big tech companies accountable to play by the rules as everyone else." I agree with that statement. The CFPB is not becoming a tech regulator as much as tech companies are becoming banks or are becoming involved in the conduct of banking. By subjecting large tech companies to the same consumer privacy standards that apply to financial institutions under the federal Gramm-Leach-Bliley Act, the rule will also protect consumers against massive data collection and the monetization of personal information. The CFPB estimates that the proposed rule would only apply to 17 entities. The agency has also made clear that its supervision of non-bank institutions is based on risk, size, and financial transaction volume, as well as the extent of state oversight. That is why the rule includes a threshold of 5 million payment transactions annually. I look forward to hearing from our panelists this morning and other stakeholders as this rulemaking process develops. Thank you, Mr. Chairman, and I yield back the balance of my time.
Gentleman yields back. We want to thank our witnesses for being here today and making the time. You'll be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, your written statements will be made part of the record. We welcome the testimony of Carl Holshouser. Mr. Holshouser is Executive Vice President of the Corporate Secretary of TechNet. Brian Johnson. Mr. Johnson is Managing Director of Patomak Global Partners, LLC. James Kim. Mr. Kim is Partner and Head of Fintech Industry Group at Troutman, Pepper, Hamilton & Sanders, LLP. Jack Solowey. Mr. Solowey is a Financial Technology Policy Analyst at the Cato Institute. And Christopher Odinet. Professor Odinet is the Josephine R. Witte Professor of Law at the University of Iowa. Mr. Holshouser, you're recognized for 5 minutes to give your oral remarks.
Thank you, Mr. Chairman. Chairman Hill, Ranking Member Lynch, and members of the Subcommittee on Digital Assets, Financial Technology, and Innovation, thank you for the opportunity to discuss the Consumer Financial Protection Bureau's proposed rule on defining larger participants of a market for general use consumer payment applications. I'm Carl Holshouser, Executive Vice President of TechNet, the national bipartisan network of technology CEOs and senior executives that promotes the growth of the innovation economy at the federal and 50-state level. Our diverse membership includes dynamic American businesses ranging from startups to the most iconic companies on the planet. We represent over 4.2 million employees and countless customers in the fields of information technology, artificial intelligence, e-commerce, the sharing and gig economies, advanced energy, transportation, cyber, venture capital, and finance. As you know, technology plays an important role in removing barriers to financial access and empowering Americans of all backgrounds to better manage their financial lives through safe, secure, inclusive, and reliable financial tools, including digital wallets and payment applications. TechNet and our members support efforts by policymakers to adapt and update outdated laws and regulations to meet the growing demand from consumers and businesses for these innovative fintech products. In our view, the current consumer payment ecosystem is highly diversified. Companies across the ecosystem play a wide array of unique roles, each serving different markets and offering different functionalities. Regulations focused on fintechs must always ensure that consumers are protected while continuing to allow for innovation in this dynamic ecosystem to flourish. Unfortunately, the CFPB's proposed rule fails to accomplish both of these goals. Under Dodd-Frank and the Administrative Procedures Act, the Bureau must conduct thorough due diligence before issuing a proposed rule. The CFPB falls well short of satisfying this requirement in this proposed rule. Frankly, the CFPB's lack of empirical analysis underlying its proposed rule is stark and troubling. Because the CFPB failed to follow rulemaking requirements required by Congress, the proposed rule creates an arbitrary market that is not based on data-driven analysis or the realities of the digital payment ecosystem, fails to identify specific consumer harms that would necessitate CFP supervision, and fails to adequately address the costs to the diverse array of companies that could be subject to CFPB supervision. We strongly feel that these deficiencies render the proposed rule defective. Before moving forward, it is critical that the CFPB more precisely and narrowly define the consumer payments market in which it seeks to supervise, and to conduct the empirical analysis required in the rulemaking process. At a very basic level, the Bureau should complete a cost-benefit analysis that adequately considers companies that may fall within the purview of the proposed rule, analyze the cost to the companies rather than using conservative estimates, and determine the cost that may be passed on to consumers. Until the CFPB conducts the analysis required of it by law, TechNet has urged the CFPB to pause the rulemaking process altogether and reconsider the proposed rule in its entirety. Otherwise, this rule will introduce tremendous complexity and uncertainty into the digital payments markets to the detriment of consumers and businesses across our country. We appreciate the subcommittee's attention to this important rule, and I look forward to taking your questions.
We thank you. Mr. Johnson, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, thank you for holding this important hearing on the CFPB's proposed larger participant rulemaking. I'm Brian Johnson, Managing Director of Patomak Global Partners. I previously served as Deputy Director of the CFPB, and prior to that, I served on the Financial Services Committee's professional staff. I will address my comments today first to the proposed rule and second to the broader context of recent CFPB actions. As members are aware, Congress gave the CFPB authority to subject so-called larger participants of defined markets for consumer financial products and services to supervisory examinations. The proposed rule would, if finalized, define a market for general use digital consumer payment applications. Larger participants of this market, defined as providers of at least 5 million annual consumer payment transactions that are not small business concerns, would become subject to CFPB exams. There are several reasons for members on a bipartisan basis to encourage the CFPB to withdraw and repropose its rule so that it may engage in a more thoughtful and deliberative rulemaking process. First, Director Chopa's recent public remarks, which are the impetus for the proposed rule, expresses concerns about the potential for big tech companies to engage in various anti-competitive practices. However, the CFPB is not the proper agency to address such concerns. The CFPB's supervisory duty is to assess institutions for compliance with federal consumer financial law, not antitrust law. The proposed rule lacks adequate justification because it is not grounded in consumer financial risks arising from the offering or use of covered products and services within the defined market. Second, the Dodd-Frank Act provides the CFPB with no intelligible principle to guide its definition of markets or selection of larger participants. Rather, it gives the CFPB carte blanche to expand its own supervisory reach. This violates non-delegation principles. Congress should define the boundaries of the CFPB's authority, not the CFPB itself. Third, the proposed market definition is impermissibly broad because it aggregates terms in order to cover a number of disparate functions rather than describes a coherent market for reasonably interchangeable financial products and services. Fourth, the CFPB interprets the term funds to cover digital assets, the effect of which would be to expand its regulatory authority over a large number of new products and participants. This would upend careful efforts by members of Congress to craft a balanced legislative framework for digital asset regulation. This presents a major question of economic and political significance that must be left to Congress to decide. Fifth, the CFPB's cost-benefit analysis uses a decade-old framework to calculate the expected cost of the larger participant examination. In my view, the Bureau's exam cost estimate, about $25,000, understates the true cost of an exam by at least an order of magnitude. The CFPB's failure to update its assumptions and obtain accurate information is a significant weakness in the proposal's 1022 analysis. Finally, without good cause shown, the CFPB departed from its standard practice in order to limit the amount of time available for the public to submit comments on the proposed rule, which is contrary to the spirit of the APA. Now I will address the broader context of recent CFPB actions. Regarding the non-financial consequences of CFPB supervision, I note that CFPB examiners sometimes require institutions to waive attorney-client privilege and turn over protected communications. The Supreme Court has long held that agencies cannot compel production of this information without an express authorization from Congress, which the CFPB does not have. This practice chills companies' consultation with legal counsel, which is detrimental to consumers. Also, the CFPB, unlike the OCC or SEC, does not publish an annual list of exam priorities. As a result, institutions have comparatively less insight into the CFPB's prioritization of compliance risks, and therefore less opportunity to proactively address them. Regarding rulemaking, the CFPB has recently proposed or finalized several rules on so-called junk fees as part of a coordinated campaign to scapegoat companies for rising prices caused by inflation. The CFPB's price controls depart from the traditional federal approach to consumer finance regulation. The politicized allocation of credit and capital through unwarranted market intervention constitutes a severe danger to free markets and consumer autonomy. This is not consumer protection. I urge Congress to use all available means to prevent bureaucratic central planning and overreach. Thank you, and I welcome the opportunity to answer your questions.
Thank you very, very much. Mr. Kim, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, thank you for inviting me to testify today. My name is James Kim. I'm a partner at the law firm Troutman, Pepper, Hamilton, Sanders. Today, I'm presenting my own views and not those of the firm or any client of the firm. My testimony and the views I express today are informed by my tenure at the CFPB and my subsequent practice focusing on payments and financial technology. My clients at Troutman Pepper range from banks and other established institutions to medium-sized and early-stage companies seeking to introduce innovative products and expand choices for consumers in the marketplace. From 2012 through 2014, I had the privilege of serving at the CFPB, where I was the lead attorney in the Bureau's first enforcement action involving mobile devices and payments. I also worked with colleagues in the Office of Supervision and supported examinations. and I was a member of an interdepartmental working group focusing on emerging payment products. And since leaving the Bureau, my practice very much focuses on helping companies navigate examinations, investigations, and rulemakings involving the agency. So why is the proposed rule for defining larger participants in the payment space important? Before I answer, it's worth highlighting that there is no question that consumer payments are currently regulated by a host of federal and state laws and rules that are enforced by a combination of the CFPB, federal prudential regulators, the Federal Trade Commission, FinCEN, and many state agencies. The proposed rule does not change the substance of these myriad statutes and regulations. Instead, the proposed rule is important because it seeks to define the larger participants who will be subject to the CFPB supervisory authority. The Bureau's power to examine institutions is the agency's most powerful and least transparent tool. Companies supervised by the CFPB must devote personnel and significant resources to host examiners at their offices, respond to information requests and follow-up questions, and address findings. Examinations are non-public and often last months and sometimes longer than a year. The CFPB typically extends the scope of their exams to the company's parent, affiliated entities, and other business areas beyond the covered activity, in this case, general use payment applications. Examinations lack a third party, such as a court or an administrative law judge, to oversee the process and adjudicate disputes. Companies also forfeit their attorney-client privilege during exams. With these considerations in mind, Congress carefully defined the CFPB supervisory authority by generally limiting supervision to larger banks and larger non-banks who can bear the significant cost of complying with exams. And Congress also mandated requirements before the Bureau can expand the scope of its own authority through larger participant rulemaking. I'm going to just highlight two issues in my opening statement. The first is the rulemaking requirements in Dodd-Frank and duplication with existing supervision by federal prudential regulators and state agencies. Dodd-Frank lays out the requirements for issuing a larger participant rule, and before issuing such a rule, the Bureau must consult with the Federal Trade Commission. That requirement is critical because defining a market is the fundamental prerequisite to determining who's a larger participant within the market. The FTC analyzes market concentration and enforces federal antitrust laws, and therefore Dodd-Frank requires the CFPB to consult with the FTC. Now, the proposed rule states that the CFPB consulted or provided an opportunity for consultation and input with not only the FTC, but other federal agencies. But it doesn't discuss any input from the FTC or any factors determining which products or services should be included within the same market. It's therefore unclear whether the Bureau met its statutory obligation to consult with the FTC, which plainly provides that the Bureau shall consult with its sister agency. Now, turning to duplicative supervision by state and other federal agencies, the proposed rule would create duplicative and overlapping supervision for many companies in the space. The proposed rule mentions that states have supervisory programs, but ignores that many companies potentially subject to the rule already partner with financial institutions who are already supervised and subject to examinations by the CFPB or the bank's prudential regulators under the Bank Service Company Act.
Mr. Kim, you've gone over your time. Your full statement will be in the record. And
thank you, sir.
And thank you, of course. Mr. Solowey, you're recognized for 5 minutes.
Good morning. Chairman Hill, Ranking Member Lynch, and distinguished members of the House Subcommittee on Digital Assets, Financial Technology, and Inclusion. Thank you for the opportunity to take part in today's hearing. My name is Jack Solowey, and I'm a policy analyst at the Cato Institute Center for Monetary and Financial Alternatives. The views that I express today in my testimony are my own. The Consumer Financial Protection Bureau's proposal for supervising digital consumer payment apps lacks a risk-based justification. For that reason, and others laid out in my testimony, it should be withdrawn. Since the launch of the first digital payment app, these tools have become highly successful at satisfying demand. The CFPB explains this well. More than 9 in 10 US consumers report having used a digital payment method, and a majority of lower-income Americans report using digital payment apps. In recent years, cryptocurrencies and decentralized finance, or DeFi, have further helped to promote competition and keep the United States at the technological frontier. Diverse payment tools benefit US entrepreneurs and consumers. Unfortunately, the CFPB's proposed larger participant rule takes the utility and popularity of digital payment tools as the reason to subject them to greater scrutiny. It would target market success, not market failure. The CFPB does not identify specific risks to consumers from digital payment apps. Rather, vague references to generic risks leave the proposed rule without a persuasive justification. They also create uncertainty, as when the Bureau indicates its supervision priorities will be tied to unpredictable factors. Unclear rationales and priorities provide little practical guidance. Given these shortcomings, the Bureau should withdraw the proposed rule. Even if the proposed rule were justified, it would still present multiple problems when attempting to assert jurisdiction over cryptocurrencies. The problem begins when the CFPB interprets the term funds to cover crypto. As the Bureau acknowledges, funds is not specifically defined in the Consumer Financial Protection Act, and it is not clear that the original public meaning of funds under that act included cryptocurrency. The act was part of legislation designed to address the 2007 to 2008 global financial crisis, an event predating the first Bitcoin transfer. That transfer took place in 2009, the year just prior to the act's passage. Ethereum, another major cryptocurrency, would not launch until 2015. As the CFPB acknowledges, the case law the Bureau cites to support its interpretation does not address the Consumer Financial Protection Act, but rather other federal laws. Asserting jurisdiction over crypto creates further issues. The Bureau's lack of clarity regarding key terms in the proposed rule risks mistakenly treating certain crypto tools like other fintech tools, despite key differences. Specifically, treating what are known as self-hosted or non-custodial crypto wallets as if they were the same as digital payment apps would be inappropriate. Unlike payment apps, where users rely on service providers, self-hosted crypto wallets are simply tools that let users protect the unique cryptographic keys for accessing their own crypto holdings. Importantly, these holdings are not held or documented by self-hosted crypto wallet creators. Rather, they are recorded on public blockchain ledgers that operate independently. The proposed rule also faces procedural issues when it comes to these technologies. The Bureau does not analyze the specific costs, benefits, and impact of extending authority over cryptocurrencies or self-hosted crypto wallets. Applying the proposed rule to them would raise serious concerns under the Administrative Procedure Act and the Consumer Financial Protection Act itself. While there are good reasons that the proposed rule should not be read to cover self-hosted crypto wallets, if the proposal were to proceed, the Bureau must expressly clarify that the proposed rule does not apply to these tools. Notably, the Bureau's attempt to assert authority over crypto conflicts with the work of Congress and this subcommittee in particular, to define that jurisdiction. For the long-term health of both the fintech ecosystem and the constitutional order, Congress, not administrative agencies, should define the limits of regulatory authority. Thank you for the opportunity to provide this information, and I welcome any questions that you may have.
Thank you. Professor Odinet, you're recognized for 5 minutes for your oral remarks.
Thank you. Good morning. Chairman Hill, Ranking Member Lynch, and members of the subcommittee, thank you for having me to testify today. My name is Chris Odinet, and I'm a law professor at the University of Iowa, where I teach and write in the areas of commercial law, consumer finance, digital assets, and financial regulation. I'd like to make 3 points today regarding the non-bank payments market as well as the CFPB's larger participant rule. First, and as an initial matter, the CFPB's supervision of non-bank payment platforms would help level the regulatory playing field between those platforms and banks. And the need for leveling that regulatory playing field has to do with the fact that both banks and non-banks are playing similar roles in the payments ecosystem. To be sure, we know that banks have long held a central role in the payment system, and as such, they are highly regulated institutions, and a critical aspect of their regulation is supervision. Non-bank payment platforms are acting as powerful intermediaries in helping consumers transfer funds as well as transactions between consumers and merchants. But when they do, they add additional parties and additional legs in the payment process, and that has the effect of increasing the chances for losses related to fraud, data breaches, and the insolvency of these powerful intermediaries. Now, to be sure, in order to engage in the transmission of money, one must obtain a license from various state regulators. But the requirements relative to obtaining those licenses and the degree of oversight and supervision can vary significantly among the states. So against that backdrop, the CFPB's proposal to establish a more coherent supervisory framework overseeing both banks and non-banks makes a lot of sense. It can prevent the evasion of consumer finance laws and ensure compliance across entities that are offering similar services, in this case, payment services. Secondly, another compelling reason favoring the CFPB's supervision over non-bank payment platforms has to do with their collection, use, and maintenance of important and sensitive consumer financial data. As big tech companies increasingly penetrate the payments market, a major incentive appears to be gaining access to vast troves of important and valuable information about how consumers spend money. This notion aligns, I think, very well with the tech industry's data-driven, advertising-centered business models that really thrive on harvesting consumer data. But by these firms also operating payment transmission lines that allows them to amass personalized financial data, which they can then integrate with their existing stockpiles of data to create very granular, multidimensional consumer profiles. And those very multidimensional profiles can be exploited by these platforms, as well as sold to third persons. And I think to that end, perhaps more alarming, these in-depth consumer profiles can be used for discriminatory purposes, such as unlawful differential pricing and targeted marketing. And of course, there is already a long history of discrimination against Black and Latino households and women in US credit markets. To put it bluntly, I think a lack of the CFPB's supervisory authority over non-banks in the payment system is and has been a glaring blind spot for that agency, and establishing and extending the supervisory authority of the Bureau in this area helps remediate that blind spot and establish more consumer trust in the payments ecosystem. Third and lastly, I think the inclusion of at least some forms and some types of crypto companies is much needed when it comes to CFPB supervision. These firms' business models are often very intertwined with consumer finance, but very little is known about their very intricate and largely opaque operations. In fact, it's largely through these firms' failure and unwinding in bankruptcy right now that we are finding anything about how they actually operate. And in fact, take, for instance, the high-profile collapse of the crypto exchange giant FTX. It has exposed, I think, how little was previously known about the true nature of these transactions and the handling of consumer assets. Lastly, I'll note that extending CFPB supervision over at least some crypto firms is not just good for consumers, it's also good for other crypto firms. So while robust supervision can help detect and deter consumer fraud before it happens, it will also drive bad players from the market. So in conclusion, we jumped generations in the payment system just over the few years of the pandemic. And the CFPB's rulemaking in that regard is sorely needed. I think it is well aligned with safeguarding American households, as well as maintaining a secure and competitive payments landscape. Indeed, given these platforms' immense growth, this rule is actually quite long overdue. Thank you.
The gentleman yields back. Thank our panel for your excellent testimony. We have the privilege of the ranking member for the full committee, Maxine Waters, is here, and I yield to the ranking member for 1 minute.
Thank you very much, Mr. Chairman. I have long raised concerns about big tech's expansion into financial services, and I'm pleased that the CFPB is finally taking action to oversee these companies. Big tech already dominates markets, possesses massive amounts of consumer data, but has not been subject to the CFPB supervision that banks and other financial institutions already follow. When I was chair, this committee held big tech to account, including by convening a hearing with Facebook's CEO, Mark Zuckerberg, over his plans to develop a cryptocurrency called Libra. Moreover, when Democrats led the passage of Dodd-Frank Act, we presently empowered the CFPB to supervise any large non-bank, including big tech, when they facilitate payments or offer financial products to consumers, to ensure that consumers are always protected, no matter who they are dealing with. I am pleased they are using these tools as intended, and I look forward to today's discussion. And I yield back.
Gentleman yields back. Yield myself 5 minutes for initial questions. In my view, it's an understatement to say the CFPB has been controversial since it was created 13 years ago. It's been talked about, as the ranking member said, for that past 13 years in this committee about its legal authorities under Dodd-Frank and its constitutional funding structure. Because the CFPB often asserts its authorities broadly, it's important for Congress to be a check. For the larger participant rulemakings like this one, defining a market is a prerequisite to determine what companies are, in fact, larger participants. It's really important for an LPR to set a narrow and clearly defined market because it allows the CFPB to subject non-bank consumer finance companies to its full supervision, as I said in my opening statement. It's not just about the product regulation. It opens those companies designated for full supervision and examination, even if they're not statutorily enumerated. However, I've got concerns about the Bureau has chosen to set an overly broad and unclearly defined market in this rule over companies in the, quote, general use digital consumer payment application space, close quote. Legal precedent and the antitrust laws dictate products that are in the same market if they're reasonably interchangeable by consumers for the same purposes. This matters because the CFPB is supposed to consult with the FTC when defining the market, and it's unclear from testimony today if, in fact, the CFPB met its obligation to do so. In contrast, this proposal attempts to sweep in practically the entire payments ecosystem by relying on the definition of general use, and thus it's overly broad and ambiguous. Mr. Holshouser, does TechNet and its members view these three types of products as part of the same market? That is, peer-to-peer, wallet functionaries, and access to digital payments. Are they all part of the same market?
No, general use data consumer payment applications is not a market. That's an arbitrary conflation of a lot of different products and services.
Does the CFPB's overly broad approach and unclear definition of a market threaten innovation and competition in the space?
Absolutely. We have to protect consumers and safeguard them, but onerous regulations like this will have a chilling effect on innovation, particularly for small businesses and startups. You know, people in a garage who are just trying to make a dream work. It's really unclear whether or not, particularly with the 5 million transactions being so low, who would be covered in this. It's definitely more than 17. But if we're going to impose this type of onerous compliance on a really small startup, we're impacting our job growth and our ability to compete.
Very interesting. Mr. Johnson, on that point, I mean, I think MasterCard might do 160 billion transactions a year. So in the payment space, the numbers are in the billions when it comes to consumer payment transactions would be my judgment. But you were at the CFPB. Do you have any perspective on the 5 million number as being way too small, or, you know, is it a Goldilocks number, or not a right number?
Well, Chairman, I would say it's the onus is on the Bureau to prove why that's the correct figure. And
Did they do that?
I think they have failed.
What evidence have they provided that 5 million is a great place to start on this topic?
You know, putting a finger in the wind and seeing which way the direction blows. You know, my written testimony says I believe the justification provided by the Bureau in this instance is inadequate. And, you know, one measure to look at here, you know, to your question about market definitions, in each of the 5 prior larger participant rules that the CFPB has proposed, was very easy for the Bureau to actually define those markets. It took 2 to 3 pages in the definitions. Here, just as a metric, the CFPB has struggled for 7 pages in the Federal Register to try and define this market. And I think that speaks volumes about the struggle the agency's undertaken.
That's very helpful. But that lets me ask you this, again, based on your experience. Should the LPR process be statutorily reformed? Should we direct the CFPB exactly how to propose an LPR? Provide more definition instead of this fishing expedition in comparison to the consumer debt collection rule in 2012, the auto financing rule back in 2015. To your point that they were very specific, this seems overly broad.
At a minimum, Congress ought to provide an intelligible principle for the Bureau to follow in promulgating its rules. That could include a list of statutory factors the Bureau must consider for setting a market definition and for setting the manner in which it establishes larger participants.
My time has expired. Thank you. If you have further on that or anyone else, please submit it for the record. Without objection, I'd like to propose that some letters be inserted in the record. December 18th from Republican members to Director Chopra. January 30th to Director Chopra from Chairman McHenry, myself, and Mr. Flood, and a letter dated January 5th from Democratic members, Mr. Himes, Mr. Gottheimer, et al., dated January 5th. Without objection, they will be included as a part of our record. And now we turn to the ranking member for Massachusetts, Mr. Lynch, for his questions for 5 minutes.
Thank you, Mr. Chairman. Again, I thank the witnesses. Professor Odinet, so I was here when we created the CFPB. I was here during that debate. And the goal here and the statutory direction for the CFPB was we were trying to provide a single point of accountability for enforcing federal consumer financial laws and protecting consumers in the financial marketplace. Why would this proposed rule be outside of the regulatory framework that we set up for the CFPB? This is exactly, in my mind, this is exactly what we created the CFPB for. We understood, even back then, not that long ago, that technology was changing. We understood that, so we didn't put limitations on technology for the CFPB. We said protect consumers in the financial marketplace. Full stop. Full stop. So now technology companies are getting into the financial marketplace in a big, big way. $300 billion so far in peer-to-peer apps and other platforms. So why explain to me why the CFPB would not be that would not be in the legitimate purview of their regulatory mission?
Thank you for the question. I think that regulating this space is absolutely within the CFPB's jurisdiction, and I view it not so much as the CFPB trying to regulate tech firms, but as the CFPB exercising its authority as directed by Congress to regulate, and in this case, to supervise non-depository institutions, non-banks. It just so happens that these non-banks often bill themselves as tech firms, or the term that has become so popular, financial technology companies or fintech companies. And this point about digital payment firms having to abide by the same laws, the Electronic Funds Transfer Act, the Gramm-Leach-Bliley Act, but not in the same way that banks do with respect to supervision. I think really accentuates a divide between banks and non-banks, or shadow banks and banks, which remains an issue even after the 2008 crisis. I think we saw this most significantly in the run-up to that crisis, where banks, chartered institutions were subject to one set of rules, and non-banks, which was largely the engine of subprime lending, were not. And I think it's worth saying what I mean by not subject to the same set of rules. That's really along two dimensions. First, they don't have the same sort of safety and soundness requirements that banks have. The result is that their business models can come in a form that requires very few reserves, also very thin margins, which makes them vulnerable to shocks, which in turn can trickle down to consumer harm. And then supervision being the other side of that. These firms generally, while they have to abide by the same rules, they're not subject to the same monitoring.
I got to jump in here. No, I appreciate that. So I've heard from other witnesses that there's no risk-based foundation for the CFPB to act. But of the 24,000 cryptocurrencies that have been launched, over half, 14,000, have died. So people have lost their investment completely. Those cryptocurrencies have gone dead, gone to zero. So we know there's an abundant, never mind, FTX, Mixin, Aeron, Terra, Paycoin, BitConnect, that have all gone to zero. There's a huge amount of risk and volatility in that, and yet there are some who say there's no risk-based reason for CFPB to venture into this. And let me just ask you this last question. So if I set up a banking system that has all of the bells and whistles, all of the banking regulations for one group, and then I create another one that has no regulations, completely unregulated, where is the money going to migrate in your estimation? Where will the money migrate and the financial activity migrate to? The heavily regulated one that protects consumers, or the fintech area with no regulation?
I think quite simply, it will migrate over to the non-bank area because there are lower regulatory burdens in that space. But the trade-off there is that there can be more consumer harm in that space because there is less watching of the players in that market.
Thank you. I yield back.
Gentleman yields back. Mr. Lucas of Oklahoma is recognized for 5 minutes.
Thank you, Mr. Chairman. The U.S. banking sector is among the most highly regulated sectors in the country. And in 2010, the passage of Dodd-Frank unleashed more than 2,000 pages of sweeping reforms and new regulations across the industry. Dodd-Frank also established the CFPB, giving the new regulator broad authorities over banks and non-banks. Part of this authority was supervision over the larger participants in consumer financial markets. CFPB's proposed larger participant rule from this past November is the 6th rule in this category, this time aimed at digital consumer payments applications. This rule would allow the CFPB to supervise certain non-banks that provide money transfer services to consumers. Mr. Holshouser, let's talk about some fundamentals for a moment. You discussed in your testimony how CFPB does not follow the Administrative Procedure Act. Can you expand on that? So that's one of the fundamental issues, playing by the rules.
Well, there's a statutory rulemaking process that has to be followed, including plenty of time for respondents. I think that 60 responses were heard in this case in what really was 41 days. If you include all the holidays, it was supposed to be 60. They also have to provide a justification of consumer harm and a reason for why they need to do this. And they need to explain who's going to be regulated and how it's going to happen for a response. Just to quickly answer so you can have it back, that's in and of itself not sufficient.
Mr. Kim, this isn't new for CFPB. Could you highlight the importance of a robust Administrative Procedures Act process? Why does it matter?
It matters because the agency does have a lot of power, and in order to exercise its power, it should follow its statutory mandate in Dodd-Frank and other acts, but primarily in Dodd-Frank, And so I think, in order to have the right balance of executing its mission to protect consumers, exercising its broad regulatory powers, it has to follow the mandate from Congress.
There's been a significant amount of questions regarding the details of the rule. For example, the CFP does not clearly define the term funds. And there's concerns that this could rope in entities that transfer assets such as securities or even commodities that are outside the purpose of this rulemaking. Mr. Kim, could you explain how elements in the proposal such as this are overly broad?
So Dodd-Frank has a specific requirement, or really, I think boundaries is the better word, saying very clearly that the CFPB's jurisdiction ends where the SEC and the CFTC's begins. So I think it's pretty clear that those two sister agencies have been very active in the digital assets and crypto space, and so the Bureau should, I think, respect and recognize the jurisdiction and the effort and the investment by those agencies and Congress in the digital asset space.
Mr. Johnson, could you offer your perspective on the far-reaching nature of the proposal? This has long-term impacts.
Yes, Congressman, it does have long-term impacts, and I think the impacts will manifest over time due to the confidential nature of the supervisory process. So an overbroad market definition, an imprecise establishment of the asset threshold for determining larger participants mean that an unknown number of institutions will be subject to supervision. As a confidential process, the public won't understand what the Bureau does behind the scenes afterwards, and I think that's the primary risk.
Focusing in on the requirements under the proposal, does the CFPB outline any specific examination procedures for larger participants offering covered payment services? And I'll direct that again to you, Mr. Johnson. Please give us a sense of what details the CFPB lays out in my remaining time.
The only reference I'm aware of is the general statutory requirement that the supervisory process itself be risk-based. Notably, the rule is not risk-based, and the Bureau's determination of the market and the institutions subject to the proposed rule is not risk-based.
With that, Mr. Chairman, my time's about to expire. I yield back.
Gentleman yields back. The ranking member of the full committee, Mrs. Waters, is recognized for her questions for 5 minutes.
Thank you very much to Professor Odinet. The misleading title of this hearing suggests that the CFPB's larger participant rule would restrict competition in payments. But if anything, this rule should increase competition by ensuring that the largest companies are not able to leverage their size and data to unfairly crowd out smaller companies. This is a concern because some of these big tech companies do not have the best record when it comes to consumer protection. Meta, for example, has engaged in illegal data practices and has been a repeat offender of regulatory orders, highlighting the importance of supervisory authority in this space. Can you talk about how this rule would help smaller companies by keeping the biggest companies in check?
Thank you for the question. I agree with you that market dominance is a real concern in the non-bank payment space. The dominance and the concentration of the consumer payments market by a handful of companies poses, I think, some significant dangers. We know that when a small number of companies control the majority of the market, that does limit competition, leads to higher prices, and of course to reduced innovation. Also, lower income households facing financial constraints may be disproportionately affected by having fewer alternatives and, of course, are more vulnerable to those price increases. Also, market dominance can stifle diversity in the consumer payment space by limiting access to services that are more tailored to the needs of specific demographic groups. I see this rule as being in service to addressing that market concentration. So to give you an example, the CFPB, with supervision authority in this space, could monitor instances of unfair and deceptive acts and practices by non-bank payment firms that make it more difficult for consumers to untangle themselves from their payment account relationships and thus move on to other providers that might be more optimal for their uses.
Thank you, Professor. Can you also speak to the broader concerns about the potential for monopolistic use of data and misuse of market power by big tech companies? How concentrated is the market for payments currently, and what risk do you foresee in the absence of enhanced supervision by the CFPB under its new proposed rule?
So some of the empirical data right now indicates that a vast majority of US households use just a few of the major payment platforms. I think I saw 56% of US adults use Venmo and PayPal. So that's a great deal of concentration. And I think that level of concentration and the way in which it generates very sensitive consumer financial data raises really significant concerns, particularly relative to privacy. I think this rule is animated by that concern. We know that major tech companies build their business models around the large collection and analysis of user data, like browsing histories, social interactions, and search inquiries. Having this payment information helps build even larger stockpiles of data about consumers, which, held by just a few companies, can be very powerful in, as I mentioned in my earlier remarks, unlawful price differentials as well as targeted marketing.
Thank you so much. Mr. Chairman and members, I served on one of the conference committees of Dodd-Frank. I was so happy that consumers finally had an agency dedicated to taking care of their concerns. And so, Mr. Hill has said it has been controversial. Controversial because the opposite side of the aisle did not like the idea that the consumers were now going to have influence and power. So I'm very thankful for the hearing, although it is entitled in a misleading way. But this brings out what the CFPB is responsible for, what they should be doing, and it does not continue to have to take certain kind of criticism from the opposite side of the aisle, who never liked the Consumer Protection Bureau. Thank you, and I yield back.
Gentlewoman yields back. Mr. Rose of Tennessee, recognized for 5 minutes.
Thank you, Chairman Hill, and thank you for our witnesses for being here with us today. Recently, I was made aware that on February 23rd, 2024, my birthday, incidentally, the Consumer Financial Protection Bureau disclosed that a company had made the decision to challenge an order that sought to establish supervisory authority based on, quote, risk determination, close quote. Director Chopra has described the agency's authority as the ability to decide that a company is risky and subject it to supervision through its statutory authority. Mr. Johnson, are there any meaningful considerations the CFPB is required to make before determining a company is risky, or has the CFPB set this up as an arbitrary process where they have near unlimited discretion?
The standard of evidence that the Bureau has established through its procedural rule is quite low. And the real problem here is that the Bureau changed its procedural rules to make non-public confidential processes associated with the supervision of institutions public in one instance and one instance only, and that's where the company challenges the proposed determination. So this creates leverage for the agency to say, we want to supervise you, and if you fight us on this, then we're going to publicly name you as having challenged that proposed designation and subject you to, among other things, class actions and reputational harm.
Thank you. One of the factors that the Consumer Financial Protection Bureau's proposal uses to determine if a non-bank covered person would be included in the general use digital consumer payment application space is whether they provide at least 5 million covered transactions annually. Several market participants have indicated that this threshold is alarmingly low. Mr. Holshouser, would you describe the potential market impact if the CFPB categorizes entities with such a small market share as larger participants?
So the minimum 5 million transactions is alarmingly low. If you think about just some of the small to medium-sized businesses having tens, if not hundreds of thousands a day, that threshold is so low, it's obvious that it's an attempt to increase the purview of oversight of the CFPB, which will, as I mentioned earlier, have outsized effect on startups and small and medium-sized companies who are trying to innovate and grow, and disproportionately affect them.
Thank you. Appreciate the insight. Mr. Kim, how has the CFPB historically determined thresholds for identifying entities to be considered larger participants under the larger participant rulemaking?
In the past, they have conducted, data-based research that's specific to a very well-defined market, and so there hasn't been, I think, the uncertainty that there is today with this rule. So for example, with credit reporting, that's a very well-defined market, so I don't think there was a lot of debate or discussion or uncertainty about what is large in that market. Same for a lot of the other LPRs. I think today's hearing, highlights the uncertainty with this particular LPR.
In your view, Mr. Kim, did the CFPB conduct significant analysis to arrive at the threshold in the proposal?
I don't see it in the proposed rule. I can't tell you what their basis was for $5 million. I can say that very anecdotally, there are, as Mr. Holshouser said, smaller to mid-size payment companies that would easily meet that threshold within a matter of months.
Shift gears a bit. Mr. Johnson, in addition to the larger participant rulemaking, the CFPB is attempting to create a non-bank registry. I signed a letter that my colleague, Mr. Ogles, led in May of last year, highlighting our concerns with these actions by the CFPB. The CFPB has justified the need for a costly registration system where non-bank companies, quote, self-report public orders like enforcement actions or consent orders so that consumers can be on the lookout for repeat offenders. Mr. Johnson, isn't this information already public?
It is, and other aspects of that proposed rulemaking are equally troubling.
And I see my time has expired, so I yield back, Mr. Chairman.
Gentleman yields back. Mr. Sherman of California, recognized for 5 minutes.
I, too, would like to criticize the CFPB. It has taken them over a decade to come up with a rule defining who would be subject to some future rule. While consumers need the protection now, we may get it in several more years. This initial pre-rule is long past due. Been in this town for a long time, and I've snuck in at least once to lobbying 101 secret classes. The rule is very simple, but the teaching is simple. If the facts are on your side, argue the facts. If you're on the side of good public policy, argue the public policy. And if the facts are against you and the public policy is against you, argue the procedure. And that is mostly what we have here. People telling us that the procedure is somehow off. Now, the most extreme of those arguments is to have the cryptocurrency industry come in and say how god-awful, outrageous it is that somebody would treat crypto as a currency. If you aspire to be a currency, you should aspire to be regulated like a currency. And like our ranking member, like the chair, or the ranking member of the subcommittee, I was here for Dodd-Frank, and I can assure you that when we said funds, we certainly included anything that qualified as a currency. Banks have long not really enjoyed the Community Reinvestment Act, and so the high-tech companies have decided, well, if we can be a bank but call ourselves Fintech, then we don't have to live with the Community Reinvestment Act or a host of others. Mr. Odinet, okay, PayPal is holding on to, I think it's about $18 billion of customer money. I assume that they invest it as they will, maybe safe investments, maybe speculation. If they go bankrupt, does the FDIC reimburse the customers?
Thank you for the question, and the simple answer is no. Those customers are holding their funds with a relationship only to that non-bank intermediary. The FDIC
So
insurance
it's like loaning money to your brother-in-law if your brother-in-law is Sam Bankman-Fried.
Yes.
Okay. I'll ask Mr. Holshouser, representing TechNet. If one of your members goes bankrupt, will the other members chip in and make the customers whole? Or will those customers, voters, be here demanding that Congress bail them out?
Well, it depends on what side of the fintech industry you're speaking of. You know, there's zero liability for credit and debit and other products, but there is some exposure.
Well, you've got 18, right now, they're holding on to $18 billion. They are investing it in either something safe or maybe pork bellies. I don't know where they put their money, and wherever they put it today, they could have put it somewhere else more risky tomorrow. Your members aren't going to bail them out. They're going to be here demanding a bailout from Congress. I'll point out that the deal with Venmo is that you pay 1.75% to get your money 3 days earlier. I don't think APR is really the way you should evaluate this, but for those of you who are fans of annual percentage rate, that's charging the consumer 213% annual percentage rate. Yes, it's only 1.75%, but that's just for 3 days instead of for 365 days. So we have a situation, Mr. Ogundai, I can't think of any other situation where ordinary Americans put their money in a financial institution that is totally unregulated, allowed to invest their money in pork bellies or mongoose coin or whatever they want, and they have no insurance. Can you think of any other place where millions of Americans have their money at that kind of risk, where they deposit their money and they think it's there?
No, nothing comes to mind. But to your point, I think the real danger of the way consumers interact with non-bank payment platforms, and I'll say this is also particularly true for crypto firms, is they do so under the misperception that when they do, they enjoy the same sort of regulatory protections they have when they deal with a broker-dealer and they invest in securities or deposit accounts when they deal with banks, which is manifestly not the case.
Thank you.
Gentleman's time has expired. Mr. Davidson is recognized for 5 minutes, the Vice Chairman of the Digital Assets and Fintech Committee.
I thank the Chairman. I think it's great that we're having this hearing, and it's important that we address just the growth of government. It seems like the government expands every year. We do have one party that campaigns on a smaller government. We're not doing so well. Every year, every Congress, we get more government. One of the guaranteed to grow forms of government was the Consumer Financial Protection Bureau, and the mission and cause are important. I think we have multiple ways to try to address that. But one of the things that's important that we get the right kind of government wherever we have it is that participation. So, Mr. Kim, in the most recent proposal for more government by the CFPB, they state they don't have to demonstrate that any customer harm has even occurred. Could you explain what the bare minimum CFPB has to show to bring an entity under its supervision?
The statute, and talking about Dodd-Frank, requires a cost-benefit and risk analysis. So in identifying, number one, a market that is ripe for supervision, it should identify risk to consumers in that market. So that's what I see as lacking in the rule.
Yep, thank you. So I guess cost-benefit might not overtly address harm, but it seems like there's always a case. We just need more government. And one of the footnotes CFPB tucked into their proposal, many believe that would give the Bureau supervisory authority into divisions within a company that are outside the scope of the proposal. What is the practical impact, Mr. Johnson, of including that wide sweeping statement in their proposal?
Congressman, I think you're referring to the statement where the Bureau says that if an institution qualifies as a larger participant within a defined market, CFPB not only achieves supervisory authority, can examine for that product line that drew it in as a larger participant, but can thereafter and forevermore examine the institution for any other product line that may be a covered product or service. And I think that expansive view of the Bureau's authority is contrary to the specific process that Congress established for identifying a larger participant within a specific market.
Yeah, thank you for that clarification. It's the hook that allows kind of more spread. So I think of it a lot of times government's sort of like an invasive plant. Once it gets in a field, it just keeps growing. And the only way to get it out is to dig it up by root and branch. And if it's actually doing something useful, you at least have to prune it to make sure it doesn't overtake everything else. And I think companies that find themselves under regulatory scrutiny are frustrated because there seems to be no satisfaction of the amount of regulation. There's always more. That's particularly true in the digital asset space. So we've seen digital asset companies come to the CFPB saying, or come to the SEC in particular saying, please regulate us. We want clarity. We're happy to cooperate with you. What do you need to know? And they share, endless information, and they never get an answer. It's like Hotel California in a sort of way. You can never check out. You can never leave. Mr. Solowey, could you highlight the particular challenge digital asset companies confront when you have CFPB trying to put hooks into them in a regulatory environment where in no other part of the economy are they getting real clarity?
I agree, Congressman. I think the lack of regulatory clarity in the digital asset space presents a real problem for market participants there. It's my view that the proposed rule only muddies the waters here. Not only does the lack of risk-based justification make the rule unjustified, but it also leaves market participants in the dark regarding how they're supposed to prioritize compliance and whether they're even supposed to be covered by the proposed rule.
Yeah, so thank you. I hope that we do what our committee has set out to do, is provide that regulatory clarity. We passed FIT 21, we passed a ban on central bank digital currency, we passed stablecoin legislation, and we importantly protected the right of self-custody. Are there any concerns that the CFPB's approach threatens self-custody? Because frankly, one of the most important protections we've found as companies maybe haven't flourished, they've had problems, some have failed, users have been harmed, notably by FTX. Isn't self-custody a way to protect yourself?
Self-custody would address the risks that FTX presented, and the proposed rule's lack of clarity regarding whether these technologies are covered only makes it harder for developers and users to deploy that technology, given the regulatory uncertainty.
Thank you. My time's expired, and I yield.
Gentleman's time has in fact expired, and we turn to the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member and the witnesses as well. Professor Odinet, the Consumer Federation of America recently submitted a statement on payments fraud for a Senate Banking Committee hearing, outlining how the scale of payment fraud is sizable and increasing, including payment apps. The statement indicated that consumers had reported 100 million in unauthorized transactions on Cash App and 57 million on Venmo in 2022 alone. How would the CFPB's proposed rule help to alleviate the amount of payment fraud in the market?
So with respect to fraud specifically, when the CFPB has supervision over a firm, it conducts regular examinations to ensure compliance with, of course, stringent guidelines, and in this case, related to Electronic Funds Transfer Act obligations for account fraud. And usually the aim is to make sure that the company is fortifying itself with consumer protection measures, as well as trying to thwart consumer fraud before it occurs. So the Bureau can closely monitor compliance with these acts to ensure that payment companies have, for instance, robust dispute resolution mechanisms, as well as disclosures. And then, of course, the Bureau can also assess a company's risk assessment strategies, and the Bureau can, in that way, delve into sort of the intricacies of the payment company's operations, kind of pinpoint vulnerabilities and fraud hotspots. Supervision, for sure, will not solve all fraud problems, but it can go a long way to make sure companies are doing their part to flag fraud before it happens.
Is it fair to say that consumers are better protected with the benefit of the Consumer Protection Bureau as opposed to without the benefits?
Yes, I think that that is absolutely true.
I see. And would the other members of the panel be so kind as to indicate whether you think fraud protection is something that we ought to be concerned with? If you think that fraud protection is something that we should concern ourselves with, would you kindly raise a hand? Let the record reflect that all have raised a hand. Let me move quickly to another aspect of this that I'm concerned with. There have been some suggestions that the threshold should be raised to 10 million as opposed to the 5 million where it's currently proposed to be elevated to. What would be the consequences of raising the threshold? Professor, I'm calling on you again.
My understanding is that the CFPB's setting of the threshold at 5 million transactions on a calendar year was designed to enable the Bureau to supervise those firms that have the most significant share of this general use digital consumer payments application market, and that it was based on available data suggesting that there is a very high concentration within this market, so a very small number of firms processing millions, perhaps billions of dollars worth of transactions in a year, while there are many other firms that are not captured by the rule, but they handle fewer transactions. So the focus was really on trying to supervise the firms that have the most critical role in this market.
You indicated a small number. I have intelligence indicating that the agency has estimated that the threshold would capture approximately 17 entities. Is that about what you've understood the case to be?
That's what I understand based on the information the Bureau has provided to the
17 entities. All right. Let's move to another area quickly. Cash App. Is it true that Cash App allows users to sell stocks, buy and sell stocks?
I'm not familiar with that particular functionality.
Anyone
Cash
familiar
App.
with the function? If so, you may speak. Cash App allowing users to buy and sell stocks? Well, I've received an indication that it does have this feature and they can do so without a commission. This causes me some concern if this is the case, because buying and selling stocks is a means by which a good amount of fraud can occur when we don't have the CFPB protecting the consumer. So I'm hopeful that maybe this is incorrect, and if it is, I will understand. But if not, I'm grateful that the CFPB is looking into this. I yield back the balance of my time.
Gentleman yields back. The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you. Just a quick question before I start, and I want to be quick, but I do want to get this on the record. All of you before coming here signed a truth and testimony form disclosing your government affiliations and contracts. I know a lot of you are speaking on behalf of things that would benefit the tech companies. Just a quick raise of hands. Do any of you have clients who are tech companies? Raise your hands. Mr. Kim, only you. Can you disclose the amount of money the tech firms pay you?
I don't know, sir. I can't say.
Well, maybe we can follow up for the record. Thank you for letting us know. I have a very naive hope here, which I'm listening to this, and my completely naive, maybe the most naive thing I've ever thought in Congress is that I really hope my wife and daughter are watching this hearing, because we have this ongoing debate at home. I do all my banking with Schwab. I do not use PayPal. I don't use Venmo. They're completely addicted to it, and I keep telling them there are different rules here, and I'm looking forward to them celebrating me as a returning hero when I get home today that I finally made this point.
First, just quick question for you, Mr. Kim. Hopefully this is going well. Do you feel it's important to maintain a wall between commerce and banking?
I think that's a policy question, sir, and I'm
You don't
not
have an
qualified to answer that one.
Okay, well, I certainly do. I asked the question because Professor Odinet, in your testimony, you mentioned that customers' interactions with PayPal is a lot like using a bank. Do you want to expand on that, what you meant by that?
Yes, I'd be happy to. So when an individual uses a non-bank intermediary, the payment still has to happen along the transmission lines of the banking system. It's just one step removed. So all of these non-banking platforms sit atop the transmission lines of the banking system, but the consumer is not interacting with the bank. The intermediary is interacting with the bank. So the benefits related to, for instance, FDIC insurance run in favor of the intermediary, and that leaves the consumer with just what is essentially a contract claim against the intermediary. As long as the intermediary has the assets to make good on withdrawal requests, payment requests, then everything is fine. But if the intermediary becomes insolvent, that insurance through the banking system ultimately does not benefit the consumer. The consumer just has a claim in a bankruptcy against the intermediary, not unlike the customers of the now defunct FTX.
I appreciate that because, I mean, I'm a dyed-in-the-wool deep free marketer. And, like, free markets mean that everybody has to play on the same playing field. And the idea that if I use Schwab and my daughter uses Venmo, there's these different rules, there's different incentives, that strikes me as a fundamentally anti-capitalistic idea. I also want to just pick on, there's this very sort of a vapid libertarianism that says that we should never give our information to the government because we can't trust government with information, but we should give all our information to private companies that have no obligation to the public interest, who can sell it to data brokers, who can then resell that information to other governments whose interests are antithetical to our own. Professor Odinet, in your testimony, you described this as a massive blind spot for the Bureau. And I wonder if you could expand on why we need to be more vigilant in protecting consumer data and what we need to guard against in this rule.
Thank you. The reason why I said that is because we don't exactly know, and it may be in some instances that the companies that collect and process the data, particularly as they use sophisticated artificial intelligence programs, know exactly what they are doing when they use data to make decisions relative to a variety of products and services. Now, we do have some visibility into that when banks are doing so, but that's because banks are subject to supervision both by the Bureau above a certain asset class, but always by their prudential regulators. But we know there's way more innovation happening in data processing and artificial intelligence outside the bank system, in the non-bank system. So in that way, the Bureau needs sort of some visibility into what's happening on that side of the house, if you will, because that's likely to be the place where there can be more consumer harm.
Okay, I see I've got 15 seconds left, so maybe if we could just follow up for the record afterwards. I do have some concerns that in some of the carve-outs for crypto, particularly as we've seen some of the companies like PayPal developing stablecoins, as we've seen some of the runs on other currencies, there are some blind spots. And so, Professor Odinet, if you have some thoughts about how we might improve the role to protect consumers,
Gentleman's time is
welcome.
expired.
Thank you. Yield back.
Feel free to respond to him in writing on that question. Committee's going to, as you know, we have votes on the floor. We're going to take a recess for not less than 5 minutes, and we'll come back and finish our questioning. We thank our panel for an excellent testimony today, so we're in recess for 5 minutes.
conclusion for the record. I want to thank all of our witnesses for being here. I now recognize Mr. Stile for opening comments. Mr. Stile, the gentleman from Wisconsin, is recognized for 5 minutes.
I thank the chair. Let me start with you, if I can, Mr. Johnson. The CFPB concede that it, quote, lacks sufficient information on a substantial number of known market participants necessary to estimate their larger participant status, end quote. In other words, they don't know the data, they don't have the data to know how many companies would be swept under the rule, so they don't know how much the rule would really cost or what the full market impacts could be. You served at the CFPB under a previous administration. Would moving forward on a major rule like this without adequate data be unusual, in your professional opinion?
I think it would be unusual and certainly present APA challenge risk. I think in some ways this is Bureau's response to an executive order and revised guidance for OMB regarding the relaxing of standards for cost-benefit analysis.
I appreciate that. I've continued concerned that the CFPB isn't doing a proper cost-benefit analysis, and the fact that we don't have data as to who's going to be swept in under such a rule, I think, is incredibly concerning. Let me continue on with you, if I can, Mr. Johnson. The law authorizing the CFPB says that the Bureau shall consult with the Federal Trade Commission to define covered persons under larger participant rules. The Bureau has said that it consulted with or provided an opportunity for consultation with the FTC, which could obviously mean the FTC did not actually weigh in. Can you explain briefly for the record why it's important for the CFPB to consult with the FTC and why it'd be a problem if the CFPB actually didn't fulfill its regulatory requirement?
The Dodd-Frank Act creates clear distinctions and boundaries between the FTC and CFPB. And the CFPB inherited certain consumer protection authorities, but not antitrust authorities from the FTC. And so it's vitally important that the CFPB consult on a regular basis, and Congress required them to consult with other agencies, I think for the reason of establishing that they are not intruding upon the jurisdiction or boundaries denied them in the Dodd-Frank Act.
Appreciate that. Let me jump over to you, Mr. Solowey. Did I say that correctly?
Yes, sir.
Thank you very much. There's a lot of uncertainty about how sweeping more companies under the CFPB's authority would impact the cost of payment services to consumers. And so how does the uncertainty about the regulatory costs impact the LPR, impact competition and innovation in the payments industry?
I think uncertainty always adds costs, even just the initial legal fees dealing with the ambiguity of whether or not a market participant is or should be covered. And then you have further uncertainty when it becomes hard to budget for those compliance risks. All of those issues take away precious time, capital, and attention that only make it harder for folks to innovate. When that is the case, consumers can miss out on new and important technologies.
Thank you. Let me jump to you, Mr. Holshouser, if I can. Let's take a broader view of how the CFPB's regulatory expansion impacts our economy and workers. At a period of time of high inflation, people can't afford the things that they need. The Bureau is targeting a very competitive industry with innovators coming from across the globe. And I'm concerned that overbearing and poorly considered regulations from the CFPB will make the U.S. less competitive and push jobs overseas. So can you talk about how the LPR and other CFPB efforts may discourage innovation and investment here in the United States?
That's a great question, and you've just got to balance the safeguards with the environment for innovation. Red tape never created the innovative companies that are the envy of the world that we have here in the U.S. It was innovators and the American spirit in our laws and regulations that allow innovation to flourish. If you just look at the EU, there's been a 40% decrease in the investment in startups in the EU since the GDPR, showing that an onerous top-down regulation has a huge constriction effect on innovation and investment. The jobs that are created in this country are mostly created by startups and small businesses. They're going to really see the impact and burden much more than the larger platforms. And I think that it's misguided to think that this rule only targets what would be seen as big players. The little ones are really the ones that need the help, and this is going to constrict their ability to grow and stifle innovation.
I share your concerns. I'm incredibly concerned that CFPB is going to continue to stifle innovation development here in the United States. Appreciate all of our witnesses. Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from California is recognized.
I believe I've already had my 5 minutes. Want to give me another 5?
The chair recognizes himself. I'll start with this. I've been concerned about the CFPB's larger participant rulemaking for some time, and I'm glad that we have the opportunity to explore its impacts further today. First, let's begin with a refresher on what the larger participant rule refers to. The CFPB has 4 broad categories of supervisory jurisdiction pursuant to Dodd-Frank. Number 1, financial institutions with over $10 billion in assets. Number 2, mortgage companies, payday lenders, and student lenders. Number 3, companies deemed quote-unquote larger participants in a consumer financial market. And number 4, companies designated by CFPB as a potential risk to consumers. If unchecked, that third category, the larger participant category, is sufficiently broad as to potentially expand the CFPB's jurisdiction dramatically over time. I fear that we are seeing that with this rule today. One example of how this rule expands the CFPB's reach hasn't gotten much discussion to this point as it relates to merchants. The CFPB is explicitly barred from supervising merchants pursuant to Dodd-Frank when they are selling non-financial goods. This is a common sense guardrail. The CFPB is a financial regulator. They don't have supervisory authority over non-financial merchants in the country, and they shouldn't. However, I feel this proposed rule takes that boundary and pushes it away. One piece of this rule claims that at any time a merchant uses consumer payment information for something other than completing the transaction, including for benign purposes like research, they go from selling a non-financial good to a financial one and are therefore within the scope of the rule. Let's step back and think about that for just a moment. When a completely non-financial merchant conducts research on their payments data, even for a good reason like conducting research to stop future fraud, they could be subject to CFPB supervision. For example, if a consumer buys a recliner chair at an online furniture store, whether or not that transaction is considered a financial transaction by the CFPB would depend upon exactly how the merchant treats the information associated with it. According to this interpretation, the fact that we're talking about a merchant selling a piece of furniture is irrelevant. The CFPB still may have jurisdiction anyway. Conveniently for the CFPB, this could extend their supervisory authority to merchants selling any and all kinds of goods. This interpretation allows them to go from a financial regulator to a regulator that could have authority over anything sold online. Another way the rulemaking expands CFPB's authority is not just over US dollar transactions, but digital asset transactions. Again, this would be a broad expansion of their power. Mr. Johnson. In your testimony, you connected the CFPB's jurisdictional grab over digital asset transactions to major questions doctrine from the landmark West Virginia versus EPA case. Do you believe the CFPB has clear congressional authorization for its claimed authority over digital assets? And please explain why or why not.
I don't believe it has that authority because Congress didn't give it that authority and didn't give it that authority expressly in Title 10 of the Dodd-Frank Act.
It's a relief to hear you say that because the members of this committee have been working on delegating authority to our regulators over digital assets for over a year. It would be rather discouraging if the CFPB could simply claim authority over the space with a stroke of a pen and very little legal basis. I'd like to close today by bringing up one more issue with the proposed rule. It completely failed to assess its potential impact on small businesses pursuant to the Regulatory Flexibility Act. The rule certifies that it will not have a significant impact on small entities, but does so with no serious analysis. This is despite the fact that small businesses and sole proprietors are some of the most common users of third-party payment technology that could be clearly covered under the rule. Mr. Holshouser, you mentioned the lack of analysis regarding the rule's potential small business impact in your testimony. Would you provide some additional thoughts on this topic?
I'd be happy to. I think small and medium-sized businesses have no idea whether or not they're covered under this proposed rule, and that in and of itself is the problem. We're hearing an estimate of 17 covered firms, but I think the estimate could be well in the hundreds. But if you're a small business and you're making a decision between spending money on compliance costs to deal with this new proposed regime versus innovating new products and then selling them, which is the lifeblood of creating a new business, you're going to see a real headwind in your ability to maintain, and grow. And I think if you limit and define the scope of this proposed rule in a more targeted basis, you will certainly give more certainty to businesses who are really confused about whether or not they'd be caught into this and what that means for their ability and need for raising money to grow.
Thank you very much for your testimony. I now recognize the gentleman from North Carolina.
Thanks to our chair and our ranking member and our witnesses for being here. I represent North Carolina's 13th district, and I've said this before, the work of the CFPB is incredibly important. Their mission of protecting consumers is supported by the vast majority of Americans, regardless of political party. The CFPB recently released their larger participant rule for digital consumer payment apps in November. I understand the goal of this rulemaking, as millions of Americans are now using digital payment apps. However, I'm concerned that this rule is overly broad and lacks clarity. Mr. Holshouser, as my colleagues have mentioned, the CFPB indicated that 17 companies will be covered by this rule. However, they refuse to say which companies. Is that standard practice? What purpose is served by keeping the list of companies who would be impacted by this rule secret?
This is not standard practice, and I have no idea what this serves. Certainty is what businesses need in order to operate their businesses and know how to plan. And this lack of specificity is a real concern.
Mr. Holshouser, and again to you, given the uncertainty surrounding this rule, will companies be discouraged from offering payment services to consumers, and how will this impact competition and innovation?
Absolutely. I think it will decrease the players in the market and reduce new entrants. It will cause those that are in it who might be caught up in this rule to retract from this market, which will lessen the number of products and therefore hurt competition.
Thanks. Mr. Kim, next question to you. To justify the rule, the CFPB only performed a cost-benefit analysis of peer-to-peer products. However, the rule would cover products like express checkout that have nothing to do with the peer-to-peer cost-benefit analysis. Is it right for the CFPB to propose such an all-encompassing rule when they don't have adequate data to justify it?
I agree that the proposed rule conflates, very separate and distinct payment products and functionalities. It doesn't explain why it does so, and in not explaining why it conflates them, there's no cost benefit or any sort of empirical analysis to support that kind of overly broad definition.
Mr. Kim, again to you, how is this larger participant rule compared to previous larger participant rules?
Well, with prior ones, we weren't asking these questions. Like with student loan servicing, everyone knew who the big players were, and I don't think people really debated or had much concern about whether the threshold would capture the large ones versus the small ones. I think today's hearing highlights how there's a lot of uncertainty about the scope of the rule and its potential impact.
Mr. Kim, again to you, can you walk us through what a typical supervisor examination by the CFPB would look like for firms identified as larger participants, and describe what powers the CFPB has over an entity once it has been designated as a larger participant?
Well, they send examiners, and it's typically at a minimum several, but easily 20 to 30. And for large tech companies, I would imagine the CFPB would, bring its so-called A game and bring as many as it can. It would be probably a combination of hosting them on site, but also hybrid or virtual. And these exams last months, so we're talking about, wave after wave of information requests and follow-up requests. And then, companies often field those questions for over a year, and then maybe you might get an exam report, a year or two later. So it's significant. People have to kind of drop their day jobs to respond to the information requests and exams.
Thank you, and I yield back.
Gentleman yields back. The gentleman from Florida is recognized.
Thank you, Chairman. Wow, this has been a very interesting hearing. I say often in this room that the first hearing I ever watched as a citizen of this country was the financial services hearings when Dodd-Frank was being created. I was in the finance world, not a member commenting on the finance world. And to be blunt, and no disrespect to the staff on Capitol Hill, not a staffer writing memos about the financial world. I was actually doing it. And a lot of the things in Dodd-Frank concerned me. Most overall overarching was the CFPB. And the concern was that the CFPB would be this overarching agency with no real oversight that would just roam the fruited plain trying to figure out what they can meddle in. And obviously we're doing that today. Mr. Holshouser, we get very technical in financial services. For the people watching at home, what actually are digital payment systems? What are the actual pieces of technology we're talking about that would apply to the American consumer?
Well, that's an incredibly complex and diverse question with a lot of different aspects to it.
Just give me an example.
But you're running financial transactions through a large digital pipe, through a bunch of data centers back and forth between merchants and banks, with other regulated entities in the payments ecosystem also involved in that.
Would a digital wallet be a part of this?
That's subject to interpretation, but normally, yes.
Okay, so I'm a consumer, I go on my phone, I download a digital wallet, I could put crypto, stable coin, or potentially even cash in this wallet. Would that all be subject to the CFPB's rule?
Under the proposed rule, yes.
Okay, Mr. Odinet, Professor Odinet, question for you. Even in its infancy when Dodd-Frank was being created, did the members, I will say the Democrat members because they're the ones that voted for it, did they truly think that it would make it possible that the CFPB would regulate consumer transactions between consumers?
So I wasn't involved in that process like you. I was much younger. But what I do know is that Congress intended for the CFPB to have jurisdiction over non-bank, non-depository institutions involved in the provision of consumer financial products and services.
I don't want to overly interrupt because we're short on time. Do you know why they did that? Because of the lending market, because I was a lender at the time. And in the lending market, the issue was home mortgages, specifically ninja loans, where you could show up, say, I want to buy this house. You have no credit report, no income verification, and a non-bank issues you a mortgage to go buy a house that you can't afford. Isn't that correct?
So I think that the subprime mortgage crisis was at the forefront of Congress at the time, but that doesn't mean that the Bureau's authority is limited to the mortgage market. In fact, the text of the Consumer Financial Protection Act goes far beyond that into multiple different types of consumer financial products.
Well, Professor Odinet, I would like to opine on that. That's why Dodd-Frank is trash and is one of the worst pieces of legislation ever contemplated by this body. But let me move on. Do you think that digital wallets pose a systemic threat to the United States of America?
My understanding is that the Bureau is not making its rulemaking on the basis of systemic threat, but on the threat of consumer harm in the offering of that
Is there a
product or
consumer
service.
harm in Americans being able to actually use their resources to buy goods and services from a business, a merchant, or from another individual?
Under the limited facts of your question, no.
Okay. Is it plausible that an American citizen needs a license or needs authority from or approval from the CFPB in order to transact business and commerce?
No, but the businesses that facilitate it do.
You said in your statement that, and I want to say, quote, that businesses could discriminate based upon information that they take down in the normal course of business. Is there any evidence at all that there's been any discrimination with the use of digital wallets at all by these tech companies?
I think proper supervision will reveal whether or not that is the case.
Mr. Johnson, is there any discrimination that's been found by any of these tech companies or fintech companies actually allowing for these products to be used by consumers?
Not that I'm aware of for laws that are within the CFPB's jurisdiction.
Here's a question for you. Do you think the CFPB even has evidence to the fact that there might be discrimination with the use of any of these products by consumers?
I think the Bureau's articulated concerns in speeches and other communications speak to speculative concerns rather than actual observations of marketplace behavior.
So for the people watching at home, the CFPB is looking for something to do because they are busybodies. There is no need for them to regulate in this space. Mr. Chopra, once again, is way beyond his bounds, which is why this agency needs to go away permanently. I yield.
Gentleman yields. Gentleman from Illinois is recognized.
Thank you, Mr. Chair, and to our witnesses. Mr. Odinet, in your testimony, you note that many of the firms that we expect to be covered under the larger participants rule are large non-bank tech firms, and with business lines that benefit from the mass collection of consumer data. Typically, we think of this through the lens of marketing, usually insights gleaned from interactions with your favorite search engine or social media app to shape targeted advertisements that are more likely to get you to buy something. Others have relationships with third parties who may also have access to consumers' information. As you note, large payment providers have access to a very valuable trove of financial information about their users that can show how much they spend, where they spend it, and how they manage their finances. Now, I imagine that most consumers would deem that sensitive information. What are some of the risks of non-bank financial firms having access to that sort of information, and what safeguards do you believe are missing?
So as I mentioned in my written testimony, one of the most important and profitable kinds of information is how people spend their money, and that is exactly the kind of data that these payment processing, payment platforms are able to generate and capture. The fear, to my mind, is the ability to use that kind of information coupled with other types of non-financial consumer data, browsing histories, social interactions, et cetera, and in combination engage in activity relative to targeted marketing, price differentials on products and services that is unlawful, that is discriminatory.
Yeah, and there have been instances where perhaps even inadvertently some of the AI algorithms of some of the big firms have been doing things like, digital redlining that have, have resulted in real harm to American citizens. So how do the risks change when the firm has significant lines of business that are outside the financial services sector?
So I think this goes toward the question earlier about the separation between banking and commerce. The way in which non-bank, which is to say non-depository institutions engage in the payment ecosystem places them outside that division because they're not depositories, they're not falling under the Bank Holding Company Act. And so that allows for a level of sharing and interaction and penetration between the payment side of the house, if I can, and the commercial, we'll say the tech side of the house. And it's the combination and the interaction of those two lines of business and the data that they produce that I think poses the risk of creating these multidimensional, very granular profiles about people and how that granular information can be used in ways that we would find problematic.
Yep. In recent months, I've been happy to see the CFPB take steps to give consumers greater control over their personal financial data. While the details of the proposals are still being hammered out, the Bureau's 1033 rulemaking, I believe, is an important step to ensure that consumers' data is protected and that they have the freedom to walk away and move their data to another bank or financial institution when they determine that they could be served better. So my question is this, how does this larger participants proposal interact with other consumer protection laws, and what would it mean for something like the 1033 rulemaking?
So I think the way that supervision interacts with this idea, which you speak of, which is generally referred to like a component of open banking, is to ensure that those non-bank institutions that are covered by the rule, that are required to generate consumer data in an interface that's standardized and easily shareable, which includes, as you say, controls on how much of it is shared and the need to get reauthorizations on an annual basis are being complied with. That's what supervision is. It's not to impose new rules. It's to ensure that the rules that already apply are being abided by.
Thank you. And how does the lack of supervisory authority over digital payments applications hinder the Bureau's ability to protect consumers' financial data right now?
The problem is that when there are breakdowns in compliance with the consumer financial laws like the Gramm-Leach-Bliley Act or others, if the Bureau does not have the ability to monitor on an ongoing basis that level of compliance, the public generally does not discover misbehavior and wrongdoing until the consumer harm has already happened. I think it's also worth saying that there are benefits to supervision that were not mentioned at all today. One being, we often hear about regulation through enforcement and the fear of CFPB enforcement, but supervision happens on an ongoing basis and in a confidential capacity so that the business and the Bureau can engage in an ongoing dialogue, flag problems and resolve them before they become public.
Thank you, and my time is up, and I yield back.
Gentleman yields back. Gentleman from South Carolina is recognized.
Thank you, Mr. Chairman, and thank you to the witnesses for being here today. When examining the larger participant proposal, one cannot help but see it as another power grab from Director Chopra at the CFPB. Since his swearing in, he has consistently applied liberal academic theories with no common sense or basis in the real world. Time and time again, these theories are put into practice and result in increased cost for services, unintentionally hurting consumers instead of protecting and promoting their best interests. What is worse is that these consequences are foreseeable and even predicted by the seemingly ever-increasing chorus of those of us with business experience. Yet our warnings are perpetually cast aside. It seems that the only possible course correction will be either Tuesday, November 5th, 2024, or who knows, perhaps the Supreme Court. But for now, I guess we will continue to highlight the adverse consequences of CFPB's proposals. This time, the directors become even more emboldened, stating that the CFPB's supervisory authority is not limited to the products or services that qualify a covered institution for supervision, but could essentially capture every aspect of a given business, subjecting companies that largely provide services outside of the financial sector to the CFPB's oversight. Not only does this proposal appear to be broad, it's incredibly ambiguous, leaving many market participants questioning their status. Mr. Holshouser, the CFPB identifies 17 firms as potential larger participants under the proposal. However, the CFPB has collected data on almost 200 companies in consideration of this rule. To say the least, it appears there's widespread confusion among market participants, with many companies unsure of their designation. Given the ambiguity in the CFPB's definition of the market in this proposal, are your member firms able to say with certainty whether they're covered?
No.
Do you think that's a problem?
Market uncertainty is the bane of the existence of any business, but particularly small and medium-sized businesses trying to grow. And the 17 that are mentioned don't account for the hundreds more that are in the space that are sitting wondering, am I going to be covered under this? Even though I'm a small company, maybe I have 20 employees.
Businesses, no matter what size, want to compete on an even playing field, and they got to know the rules of the game in order to compete. This is not productive. Mr. Kim, do you find it appropriate for this rule to encapsulate both companies that facilitate transactions and those that provide a native digital wallet? And what is the CFPB's justification for such a broad scope?
I don't see the justification in the proposed rule for combining what I think are very different functionalities with different risk profiles. If you're, as I read the proposed rule, if you're merely saving and passing payment credentials and instructions, but not actually touching the money in any way, you're still covered by the rule. And then you're treated the same as a company that actually holds and moves the money. So I don't see the explanation in the rule for treating those two very different things the same way.
Unless you see it for what it is, which is just a way to expand their authority and have additional scope. Mr. Solowey, in this proposal, the CFPB includes digital assets and their definition of funds. This committee has been crafting legislation to address digital assets, yet it appears the CFPB is trying to front-run Congress and expand its authority. What potential implications could this proposal have on the digital asset ecosystem?
If the CFPB were to succeed in, as you put it, front-running Congress, it would not only add additional regulatory uncertainty to an already uncertain space, but one of the specific risks would be the application of this rule to self-hosted crypto wallets that do not exhibit the same underlying technological structure nor the same risks as more traditional digital payment apps.
Mr. Solowey, this seems like a radical expansion of the CFPB's authorities. Could the CFPB use this novel interpretation of funds in future proposals?
If unchecked and unchallenged, they could. In addition, they could take away the lesson that they can interpret and expand their authority broadly.
Also, Mr. Solowey, given the unique nature of some digital assets, does the CFPB provide sufficient guidance on which digital assets they would consider to be funds and which would be excluded?
No, they do not. They provide little by way of guidance, which is to say, essentially none at all. There are very different types of digital assets out there, and the failure to distinguish between them is one of the shortcomings of the proposed rule.
I'm not sure what this proposed rule helps. It literally only seeks to expand the director's authority, and it further complicates businesses' ability to compete in the U.S. and global economy. And I really think it needs to be reconsidered. But again, as always, I imagine that our Warnings will be cast aside, and it'll take the Supreme Court or an election to change course. With that, Mr. Chairman, I yield back.
Gentleman yields back. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is adjourned.